Life policies are legal contracts and the terms of the contract describe the limitations of the insured events. Specific exclusions are often written into the contract to limit the liability of the insurer. Common examples are claims relating to suicide, fraud, war, riot, and civil commotion. Life-based contracts tend to fall into two major categories: protection policies, designed to provide a benefit, typically a lump sum payment, in the event of specified event. A common form of a protection policy design is term insurance. Investment policies, where the main objective is to facilitate the growth of capital by regular or single premiums. Common forms in the U.S. are whole life, universal life, and variable life policies. Life insurance may be divided into two basic classes, temporary and permanent, or the following subclasses: term, universal, whole life, and endowment life insurance. Term insurance main article. Term life insurance. Term assurance provides life insurance coverage for a specified term. The policy does not accumulate cash value. Term insurance is significantly less expensive than an equivalent permanent policy but will become higher with age. Policyholders can save to provide for increased term premiums or decrease insurance needs by paying off debts or saving to provide for survivor needs. Mortgage life insurance insures a loan secured by real property and usually features a level premium amount for a declining policy face value because what is insured is the principal and interest outstanding on a mortgage that is constantly being reduced by mortgage payments. The face amount of the policy is always the amount of the principal and interest outstanding that are paid should the applicant die before the final installment is paid. Group life insurance. Group life insurance, also known as wholesale life insurance or institutional life insurance, is term insurance covering a group of people, usually employees of a company, members of a union or association, or members of a pension or superannuation fund. Individual proof of insurability is not normally a consideration in its underwriting. Rather, the underwriter considers the size, turnover, and financial strength of the group. Contract provisions will attempt to exclude the possibility of adverse selection. Group life insurance often allows members exiting the group to maintain their coverage by buying individual coverage. The underwriting is carried out for the whole group instead of individuals. Permanent life insurance. Permanent life insurance is life insurance that covers the remaining lifetime of the insured. A permanent insurance policy accumulates a cash value up to its date of maturation. The owner can access the money in the cash value by withdrawing money, borrowing the cash value, or surrendering the policy and receiving the surrender value. The three basic types of permanent insurance are whole life, universal life, and endowment. Whole life main article. Whole life insurance. Whole life insurance provides lifetime coverage for a set premium. See main article for a full explanation of the many variations and options. Universal life coverage. Universal life insurance is a relatively new insurance product, intended to combine permanent insurance coverage with greater flexibility in premium payments, along with the potential for greater growth of cash values. There are several types of universal life insurance policies, including interest sensitive, also known as traditional fixed universal life insurance, variable universal life (VUL) guaranteed death benefit, and equity indexed universal life insurance. Universal life insurance policies have cash values. Paid-in premiums increase their cash values, administrative and other costs reduce their cash values. Universal life insurance addresses the perceived disadvantages of whole life, namely that premiums and death benefits are fixed. With universal life, both the premiums and death benefit are flexible. With the exception of guaranteed death benefit universal life policies, universal life policies trade their greater flexibility off for fewer guarantees. Flexible death benefit means the policy owner can choose to decrease the death benefit. The death benefit can also be increased by the policy owner, usually requiring new underwriting. Another feature of flexible death benefit is the ability to choose Option B or Option B death benefits and to change those options over the course of the life of the insured. Option B is often referred to as a level death benefit. Death benefits remain level for the life of the insured, and premiums are lower than policies with Option B death benefits, which pay the policy's cash value i.e. the face amount plus earnings/interest. If the cash value grows over time, the death benefits do too. If the cash value declines, the death benefit also declines. Option B policies normally feature higher premiums than Option B policies. Endowment's main article. Endowment policy. The endowment policy is a life insurance contract designed to pay a lump sum after a specific term on its maturity or on death. Typical maturities are 10, 15 or 20 years up to a certain age limit. Some policies also pay out in the case of critical illness. Policies are typically traditional with profits or unit-linked, including those with unitized with profits funds. Endowments can be cashed in early or surrendered, and the holder then receives the surrender value, which is determined by the insurance company depending on how long the policy has been running and how much has been paid into it.